Corporations are big borrowers, but unless their debt matures or they have to borrow new money, they don't care what the rates are today. They care what they're going to be when that debt matures. So there hasn't been a lot of corporate debt. That's the lag effect. That's why it takes a while. People don't want to borrow money at these high rates.
Welcome to an enlightening video where market expert Mike Leibowitz from Real Investment Advice explores the intriguing dynamics between stock market sentiment and fundamentals. Join us as we delve into the world of investing, analyzing the delicate balance between market sentiment and fundamental factors. Gain valuable insights from Leibowitz as he uncovers the potential opportunities and challenges in the stock market. Get ready to navigate the exciting realm of stock market investing in this engaging discussion.
It's kind of, I feel like we're like the coyote and the roadrunner. Mm-hmm. The coyote runs off, Wile E. Coyote runs off the cliff, and he's sitting there and he looks around, he thinks everything's okay, and then he looks down and the bottom drops. And, you know, it's always hard to predict the lag effect. There's a very high correlation in manufacturing jobs to economic activity, both hiring and firing, whereas a lot of service sector, there's not nearly as much correlation. You know, like I said, doctors aren't losing jobs in a recession. Teachers don't lose jobs. There's plenty of other service sector industries that don't get fired if there's a recession, whereas manufacturing is all but guaranteed that they will. Those companies and construction, certain parts of like new home construction is booming right now. You know, at least parts of this country, we're seeing a boom in multifamily construction. You know, the question is, are they getting ahead of themselves? And will there be enough renters, you know, for the or buyers of those multifamily properties to justify the existence, or will we have an overhang? And that overhang then starts having a big effect on labor, on prices, on the economy. The Fed has increased rates at the fastest rate. So how much and over what period of time since like the early 1980s. But now this is very important. When you factor in how much and how quickly they did it with the amount of debt in the economy, you could say that the current environment, the Fed is blowing away what they did in the 80s because there was so much less debt. The interest rate had so much less of an effect because there's just a lot less debt. So what the Fed is doing is, if I would have told you this a year ago, what they would do, you'd think I was crazy. And it hasn't worked. So there's a lot of different things going on. So first of all, we can look at housing. Why hasn't housing cratered if mortgage rates are now 7%? And part of the problem with housing is that you need a buyer and a seller. And if I want to sell my house, for instance, I can sell it, but can the buyer afford it with the mortgage rate? And even if the buyer can afford it, I have to go live somewhere else. So rent prices are up, so I can rent at a very high price, or I can buy another house and take out a 7 or 8% mortgage to buy that other house. And you could make a case where you could sell a house for $500,000, turn around, buy a house for $400,000 and have a larger mortgage payment than you did before. So the existing housing market, not new homes, but existing homes, is very stagnant. There's just nothing going on, which helps explain why new homes are doing relatively well. Why both construction and new home purchases are doing well, because those are the only homes available. And there are people that want to buy homes, need to buy homes, you know, but then you can look at like cars. If you don't need to buy a car, you don't really know what auto lending rates are. You know, cars last 5, 6, 7, 8 years. So in theory, only, you know, a small percentage of those that need to buy cars are out there in the market and affected by the higher rates. Corporations are big borrowers, but unless their debt matures or they have to borrow new money, they don't care what the rates are today. They care what they're going to be when that debt matures. The corporations tend to roll over debt. So if they issue a 5-year note, the debt matures and they issue a new 5-year note. So there hasn't been a lot of corporate debt that's matured thus far. So there hasn't been a lot of corporate debt, 23 and 24. So that's the lag effect. That's why it takes a while. Now you also have the stimulus effect. So the government flooded the economy with money in so many different ways. And some of that stimulus is still flowing through. Student loans are still, you still don't have to make payments on a student loan. That'll change in theory, if Biden can't do anything in August, where all of a sudden that, a lot of people are going to be paying 300, 400, 500 and even more towards their student loan that they weren't paying for the last three and a half years. There's still a slight excess of savings. If you look at total savings and kind of the trend rate of savings, they are still running above trend. So consumers are able to draw down savings. Credit card usage has increased. Credit card balances have increased rapidly. So consumers are also using credit cards to help spend as well. So, and then there's this whole psychological aspect of the pandemic. We saw UNH reported that they're a little concerned because their older clients are starting to go to elective surgery. Because of the pandemic, they were shying away from that. So a lot of these pent up demands, behaviors from the last 3 years are coming to fruition. We didn't go on a vacation for 2 years. Let's do it up this year. Let's go on a bigger vacation. We deserve it because it's been 2 years, that sort of thing. So you throw all these different factors into the pot and you stir them up, makes it very hard to predict when the economy will eventually feel the effect of the rate hikes. But at the end of the day, I think what we really have to remember is that we are in an economy that grows at 1.5% to 2% after inflation. That's not me. That's the Fed that tells you that. If you look at their long run projections, I think it's 1.7, 1.8%. If you look at productivity growth in this country, it's about the same thing. Demographics don't do the economy any favors, and it just kind of gets worse as time goes on. And it all comes back to credit then. Credit's that marginal lever. And with rates so high and the yield curve inverted, the banks don't necessarily want to lend money and people don't want to borrow money at these high rates. So, it's kind of, I feel like we're like the coyote and the road runner. Mm-hmm. The coyote runs off, Wile E. Coyote runs off the cliff and he's sitting there and he looks around, he thinks everything's okay. And then he looks down and the bottom drops. And, it's always hard to predict the lag effect. This, because of all these different stimuluses and behaviors and everything going on, this is just so much harder. But it means that this lag effect can last longer. I think that's the big risk, is that the coyote stays in the air longer, and the Fed keeps raising rates. They're piling on to the damage that we don't see. And I think that's really what is concerning the Fed. The Fed, I think, would love not to raise rates anymore. They've put themselves in a corner where they almost have to now. And that's exactly right. And the Fed knows this. The Fed, Jerome Powell, I think it was last week in front of, was it his congressional testimony? He made statements. Maybe it wasn't congressional testimony, but he made statements. He said we have to be very respectful that a lot of our rates have not taken full effect yet. So he's telling you that he's mentioned the lag effect many times. He has. And in a weird way, I kind of feel bad for them because they have to keep piling on, making that anvil bigger and bigger. And they have to know that the bottom by definition will fall out. This is basically economic physics. You can't have a 2% economy with 5% interest rates. The math just doesn't work. And we are so highly levered, the math even gets worse. So it's a question of when. And I know it's frustrating from from those that are in bonds. It can be frustrating for those that are kind of sitting out or less exposed in the stock market. It's frustrating, but this can go on for a while. And that's why it's important to kind of follow what the markets are telling you, watch the economic data, respect the lags, respect kind of the broader macro theme of, where this country's been heading for the last 30 years, and kind of put all that together into a cohesive plan of action. So, look, I think we both agree the future looks poor, but that doesn't mean that the next 2 months can't be really good for the stock market or really bad for the bond market. It's, you're dealing with sentiment and investor behaviors versus, to some degree, reality. And most investors are backward looking. And if you look backward, this is kind of how we led off. There's no more lag effect. Lag effect is gone. Interest rates don't matter. Everything's good. Look, the economy withstood 5% interest rates. We're good. That's not the truth. That's not what's going to happen. So you have to just keep all this stuff in mind and balance, try to be very, have your opinions, but read and watch and listen to the bulls, to the bears, and try to understand what they're all saying and why the bulls may be right for a while, but why they may be wrong. And conversely, maybe the lag effects are going to be much long. Maybe we're talking another year or two, right? So try to understand and gain conviction by looking at basically both sides of the aisle.